Hi there, and welcome to the Option Pit Webinar of the Month. I am Mark Sebastian, and this is Creating Income with Options. If you have questions, save them for the most part to the end unless they're extremely pressing, and then I promise I'll take all the time you need at the end to answer questions. All right. For those of you that don't know who I am, that's me, that good-looking young man from my past. Talking to my friend Liz Clayman. And I want to remind everybody this is for educational purposes only. Options have risk. Consult your financial professional. Here, I'll bring the mic closer. And, make sure that you're aware that this is for educational purposes only. All right, this is not meant to be used as investment advice in any way, shape, or form. For those who don't know me, most of you probably do, I was a market maker on the SIBO on the American Stock Exchange for about 10 years. Since then, I started Option Pit. I also run a hedge fund called Carbon Line Capital. Option Pit is an education and consulting company. We work with retail and professional customers, teaching them proper ways to implement option strategies and manage risk. So, what you will learn. All right, we're going to talk about how in selling options, traders run their own company like an insurance company. All right, how do insurance companies make money? How do options relate to the insurance business? How to identify under and overpriced options? How to generate a position selection routine? Conditions of volatility that produce optimal conditions of trading? And an example of a trade and how it fits a market condition. So I'll actually walk through one that I put together 20 minutes ago. So, the insurance business. All right, insurance companies make money selling insurance policies to many individuals. The idea is that only a fraction will redeem at any one time. This leaves the insurance companies with excess capital to invest. All right, the risks are spread over a large area, and they reduce their risk buying insurance back in the reinsurance market. So they sell insurance, then they cover their butt on some of their more risky insurance. Very simple. Okay, that's kind of how it works. All right, and we're going to talk about policies, but do you think insurance companies would rather sell a auto policy to an inexpensive auto policy to a 45-year-old mother, or an expensive policy to a 18-year-old with bad grades that smokes cigarettes and drives a Trans Am? What do you think? Yeah, cheap to your mother, as Vanilla Ice would say. It's a much more predictable group to manage. All right, much better, much rather. And we'll talk about why. So this is my book, The Option Traders Hedge Fund. I wrote it with another hedge fund manager named Dennis Chen. Good dude. My second book, I just turned in the second round of edits for the last chapter. All right. Actuaries have it figured out. That's actually not true. There are some they thought they did, and then things like cell phone driving changed the equation completely, believe it or not. So my second book is likely to be published in the next 4 to 6 months. It's going to be called Trading Options for Edge, and I'm really proud of what we've come up with. I think you're going to really like it. It was just me writing it this time, for the most part. I got help from the Thompsons on one. So, options are like insurance policies. All right, insurance policies collect dollars up front for future obligations. All right, if you sell an option, you generate a credit. All right, you generate credit up front, taking the obligation of buying or selling the underlying security at a set price in the future. Let's compare the two. So if you look at comparing options and insurance, the top one is insurance, and the bottom one is the option traders hedge fund. All right. So you've got your underwriting and pricing. That's your trade selection. Then you've got your reinsurance operations and your claims processing. That's the risk management piece. And then customer acquisition, we like into trade execution. So that's how cheap is it for you to get your trades done, and how effective are you at getting your trades done. And then investment operations, probably a little redundant in an investment operations. You might say that investment operations is the allocation process, if you were going to add a fourth bar to this. So adapting option trading to insurance model takes some work, all right? But you can actually, but if you think about it, you can kind of see how the two work. All right, so let's kind of think about what all these things make up. So trade selection is your market selections. What do you want to trade? The pricing, your strategy selection. What kind of trades do you want? And then time frame. What duration? Risk management is your position sizing, your money management, trade adjustments, buying options to cover, discipline closing, and then portfolio diversification. And then trade execution is your route selection, your strike selection, and how you build your your trade orders. All right, so creating a trading approach. All right, the supporting functions of this business. A trading plan, a trade infrastructure, and learning processes are the key. All right, your trading plan is, all right, when do you trade, how, what conditions, how much? All right. All right, so let's start with what market to trade. First, all right, how do you tell if an option is fairly priced? Remember, insurance brokers sell overpriced policies. They have actuaries to do that. All right. Now, let's talk about the how we calculate overpriced options. We use the option model. All right. Now, at the time of execution, most of the inputs in the model are known, right? They're hard to kind of argue over, except for one. All right. So insurance companies use actuarial tables to compute rates for policies. Option traders use the option pricing model, Black-Scholes, for example. All right. And that uses cost of carry, strike price, stock price, timed expiration, and forward volatility. All right. Forward volatility. So let's look at these inputs. Cost of carry. We can figure out what cost of carry is. All right. Strike price. All right. If you can't figure out what your strike price is, then you have bigger problems. You should not be trading. Stock price, even worse. You know, if you don't know what the right stock price is, stop trading. Timed expiration. All right, if you can't figure out timed expiration, you need to go back to first grade with my kid. Now, the only one that's really tough to handle is forward volatility. All right. Forward volatility, all right, is really what the pricing model wants to use. All right. Forward volatility. But what is forward volatility? We'll talk about that in a second. Forward volatility is how much volatility is going to move going forward over the time period between now and an option's expiration. All right. Now, how many of you can tell me what forward volatility is going to be for the next week? High or low? And what level? Who knows what forward volatility is going to be? Well, yeah, it depends on the underlying, depends at 30. Yeah, if you know that it's been low, that's historical volatility. Forward volatility is something we actually don't know, and that's one of the problems. That's what we're trying to price. When we set options, that's what we're trying to price. So now let's look at implied volatility. All right, at the money implied volatility, which you might have heard of, is the market's best guess at forward volatility. Right? But is it right? Let's look at that previous, so implied volatility is the market's best guess at forward volatility. Let's look at it with fresh eyes, all right? The red line should lead the blue line by about 20 days, all right? The blue line is 20-day historical volatility. The red line is implied volatility. So take a look. Here we are at the end of April. Does it look like April has any idea that we're going to get a huge sell-off? What do you think? All right. Now, it's pretty accurate through kind of this low vol period, isn't it? This low volatility period looks right until it's really wrong. All right. Implied volatility is excellent at pricing forward low volatility. It's terrible at predicting event risk. So, finding overpriced options. So the first key is to look at realized volatility and implied volatility of the options and ask yourself, is there a trend? Is the policy expensive or too cheap? That's the first step to trade selection. So, today in our chat room, I was looking at the S&P 500. All right, this is a trade I pulled up today. I was looking at the S&P 500 and I said to myself, is it me or are calls too cheap in the SPX? And so then I fooled around and I came up with a trade. I did a May-June 2400 calendar spread because I thought upside was too cheap. As you can see, I did a 10 lat and it's up from, what time did I execute it? I executed it at 1:25 Eastern. So in the last couple hours of the day, it was up $275. How could I tell it was cheap? Oh, just you wait. That's what we're here for, isn't it? So, what to ask? What is the current, here's how to figure out if something's too cheap. What is the current realized volatility, historical volatility? So how much is the market actually moving? All right. How much is the market actually moving? All right. So make sure I interpret HV the right way. So I have to look at the data set for large outliers. Will the last 30 days be as volatile as the previous 30 days? Well, let's talk about it. All right. Prior to last Thursday, or last Wednesday. All right, last Wednesday we had this news that, sent markets down 2.5, over almost 2.5%, or about 2%. Let's just go with that. All right. Now, since then, so prior to then, what had been happening in markets? Prior to Wednesday, what had been happening in markets? Yeah, nothing. Nothing. Low volatility. That's correct. Super low volatility. All right, now, since then, what has been happening? All right, well, Wednesday we move, 45 points, 48 points. Thursday we rally 20. Friday we rally 20. And today we rally almost 13. All right. So has there been a change in market movement? Yeah. All right. There has been. All right. So far, since Wednesday, when we got that big outlier move, and this should have been something you asked yourself, since Wednesday, when we got that big outlier move, markets have changed a little bit. We are moving more, at least over the last 4 days. The VIX is pricing itself like that's not going to keep happening. But for now, we are pricing for movement. And movement is happening. So here's SPX. Oh no, this is VIX. Whoops. So you take a look, and even though this is VIX, all right, this is movement in VIX. All right, VIX had been pretty stable with a slow lean lower. And then it just, the movement had stopped. What's interesting is, we comment about how that April move did not call anything happening, but actually VIX itself, seems to be moving. All right, there's been a change in movement in VIX. I'm going to change this to VIX HV. All right, so now when I'm looking at movement, here's what I think. 10-day is too short to really evaluate actual HV levels, but it can give us a clue as to what is exactly happening right now. Was there an event in the last 10 days? Is there something that pushed movement? 20-day HV is like a month of trading data, all right, because we don't trade on Saturday and Sundays. So it's good for a look at, I like 20-day for what has been going on, what is happening right now. 60-day is a lot less noise than 20-day HV. It's good for traders who trade more part-time than full-time, and it's great to let us know the current trend, and also it can be kind of a near-term movement strength and resistance point for 20-day and 10-day. And 180-day HV is the best picture of the current long-term trend. All right, now, always look at a price chart to see if there's any huge intraday moves, right? There can be times, I know it's been a while, but do we remember days where maybe the S&P would be up 15 and then down 10 and then end the day unchanged? You guys remember days like that? Those were the days, my friends. We thought they'd never end. Those were the days. Yeah, the last time we really had a period like that was like August of 2015 through January of 2016. But the key is, and individual stocks have definitely had days like that. Amazon has days like that. So you need to look at a price chart because most HV models look at close of business to close of business to close of business to analyze how much movement there is in the market. All right. So falling versus rising realized volatility is really important. All right. And if realized volatility is rising, you want to buy strangles, condors, all right, and debit spreads. And if it's falling, that's when you want to sell strangles, condors, and credit spreads. All right. Implied volatility is the other main portion of what determines the overall success of these trades. So if you are a condor trader, the number one thing you should be looking for is falling movement. Same thing with credit spreads. Same thing with condors. Now let's talk about implied volatility. Implied volatility is how much the market is expecting the market to move over the time period. All right, it has this mean reversion tool. All right, more useful to look though at the relative median than the relative mean. So I use exact durations to look at what's going on. So 30-day IV, implied volatility, the VIX, if you will, is what might happen soon. What does the market think is going to happen in the next month? 90-day IV is more long-term trends, and that's VXV for S&P. All right, one thing I do look at a lot is VXV. All right, and that's the market's thoughts on long-term trends. Implied volatility is the market price volatility buyers and sellers of options are trading that bring volume to equilibrium. It's that fair value. All right, the trick is fair value changes as movement expectations change. So here's IV of SPX, and you can see 90-day is a lot smoother than 30-day. A lot smoother. All right, it's those periods where you can get an idea of expectations. I mean, in terms of what's changed. All right, that IV, if you look at how the movement is, all right, it's kind of what the market thinks is going to happen. So if you are a straddle trader, a butterfly trader, or you like buying debit spreads, implied volatility is going to be the number one thing that determines whether you're making money or not. All right, the next one is that realized HV, right? If I own a straddle, what am I looking for? I'm looking for IV to rise, and I'm looking for movement to rise. If I'm short a butterfly, an iron butterfly, then I'm absolutely looking for that movement to increase or to decrease, excuse me. All right, now finally, IV-HV term structure. 30-day IV is lower, or in contango denotes a calm market. Should be considered logical, all right? So the one thing I think a lot of traders forget is that when markets throw out logic, all right, when they throw out logic, then all of those systems that you have in place can stop working, all right? It should be, all right, the market is likely somewhat reasonable, all right? So if we're in contango, all of those rules-based systems are more likely to be effective. All right. If we're in backwardation, that's when 30-day IV is higher than 90-day. That means the market isn't logical. It's reactionary. All right. Quick dollars are important. If you make money, get out of the way. They're less likely to hold any trend, and the assumptions are less likely to work. If you don't have anything cool like my Live Vol X, you can use VIX and VXV to evaluate S&P. Lots of people do that. I actually have a scanner that I look at that actually keeps track of that. So within contango and backwardation periods, there may be a period of time where options seem under or overpriced in one month or another. So even after you evaluate where IV is, you now need to evaluate where the best month is to trade. All right. So look at current mean relationship levels. If VIX has been trading 1 point under VXV for the last 90 days and moves to 2 points under VXV, something has changed. Front month has been smashed. There may be a buying opportunity. In normal periods, supply and demand create trades. Traders look to sell premium or buy premium can really move around volatility. Term structure is going to be the number one determiner of how calendars, time spreads, diagonals, and double diagonals perform. So take a look. All right. Do you see places where movement has pushed options one way or the other? if I was going to do a calendar, what months would what are there any periods, let's say prior to, what would be, so let's just say this. If I was going to buy a June 12 contract as a part of a calendar, what options would I most likely want to sell, knowing me, the professional? No, the June 2s. Yep. Or the May 26s. No, not the May 30s. Those are the cheapest. Those are the ones I'd want to buy. So the May 30s at 618, I would want to buy. I would potentially buy those and sell the 24s or the 26s. Do a 4-day time spread. I would want to sell the May 26s or the June 2s. Right? Because what I'm paying, 723, is about on par with what I'm getting in terms of volatility. You can make an argument that maybe I'd want to do the June 9 versus June 12, but that far out of a 3-day time spread's a bad idea. I love 3-day time spreads. Time spread's another term for a calendar. All right. I love 3-day time spreads. I just don't like them a month out. All right, so now let's do a little evaluation process. Here's Apple stock. What would you say the trend is? It is up. All right. Now, what about HV? Here's Apple HV. What's the trend? It's been rising a little bit. Been rising a little bit. Actually, as I look at it, it's been rising a little bit. I'm actually going to change my opinion on this trade. Now, taking a second look. Yeah. So now, what about IV? I mean, you can see it's way above those lows. In term structure, you can tell front month, it's cheap to buy here, expensive out here. All right. It's supposed to be Apple. And I'm actually going to change my opinion here after looking at it again. All right. So now let's watch through the price action. Price action has been rallying. What's the best trade for HV? If you're just looking at HV, HV's rallying. What's the best trade for IV? IV's been relatively strong. What's the best trade for term structure? It's got a contango. I mean, well, calls. I've definitely done some of those. I've been extremely effective at picking calls to buy and in Apple. So I have a rising HV. All right. Somewhat firm IV and a contango. What fits? So given the price action of the stock, the falling HV and the strong HV and a firm IV, I would do a debit spread. I'm sorry. I would also consider a short time spread if I had portfolio margin. Bull spread, correct. So now what month or week? If you have to buy a month, what do you want to buy? Well, yeah, I'm looking at, I think the June regulars look kind of cheap compared to the 9s and the 23s, right? Yeah. All right, so I'm going to take a different picture here, and we'll rename this spread because I might use this presentation later in the week, so I want it to be right. I actually dropped a presentation in the handouts. So as I look, if I go into June, I mean, I've got a bull calendar spread on, but that was a couple days ago. That's been nice. So I might look with the stock 154, I might look to buy the June 155 calls and then sell the 160s. You can see I get pretty decent volatility. I could do the 162.5s, and I actually get a volatility credit on that. This is where skew comes into play. So I might look at, I mean, $1.87 for a 7-point vertical with a month to go. That ain't bad. I like that. Don't you? That's not bad. And there you have it, folks. All right. All right, so now, in summary, insurance companies make more by selling premium. Option traders have to find premium, learn to read price, HV, IV, term structure, use information. All right, so now I want to tell you about what's starting tomorrow. Starting tomorrow at 7 Eastern Time, if you haven't purchased anything from us, this is probably worth doing. I think it's really good. I've looked at kind of Andrew and I have kind of worked on a syllabus here. I'm going to be presenting a sounds like 4 of the 10. All right, and it's our what we call Option Pit Masterclass. So it's 10 classes where we're going to cover credit and debit spreads, butterflies and condors deep, calendars and front spreads. We're going to teach you how to manage risk by buying options, covering stuff. We're going to teach you some actual tools for really sniffing this stuff out. And we're actually going to put on a trade every week that we'll follow along with. All right. And it's absolutely worth. So when we're done with it, when we're selling it in our recordings, we're going to charge $2,000 for the course. Right now it's $997, and if you use code capital L income, it'll take $175 off. Class starts tomorrow. I know this is a late warning, but this is going to be a really good class. What about a debit spread? I mean, if you're talking about credit spreads, you're also talking about debit spreads, right? What's the difference? Credit spreads and debit spreads are the same thing. It's just where they're placed that matters. All right, what questions? And you go to optionpit.com/income trading, and you can sign up, and I'll also have a copy of this webinar posted there. All right, any questions? Or are we all watching the Cubs game? Discount for X-Gold members. Email me and I'll send it to you, Jack. And I will send you the revised slides, yes. So let's just save that. Yeah, shoot me an email and I'll send you. You should have gotten, if you're X-Gold, you should have gotten an email from us with the with it, but I'll send you the code. There is a code, and it's a better price. It's only $600 for X-Gold members. The benefits of being gold. Now, one other thing, if you've been thinking about doing our gold class, getting a gold membership or a platinum membership, if you do purchase those, I'll include this course for free. So just something to think about. All right. If we don't have any questions, I'll wish everybody a great day, and I'll talk to you guys soon.